Welcome to my channel. This is Forex. So in this video, I'll be breaking down what's market structure. I'll break it down in such a way anyone who is new or seriously battling with market structure can understand what the market structure is. I'll be covering some content. You can clearly see all of the content I'll be covering, from what is market structure down to common mistakes traders make while mapping out the market structure or marking out the trends. You might be asking yourself what the market structure is. Market structure, think of it like the foundation of price action. Every move the market makes to break out and the pullback. Market structure is simply the way price moves in phases. You see price going up, creating highs and lows. So in this case, let's say you came to the price chart and you don't really understand what the market is doing. That's you don't know what the market is telling you, whether it's the buyers that are in control or it's the sellers that are dominating. But then once you understand this flow, you stop guessing entries and then start flowing with the market and not against the market. So I will show you 3 basics of the market structure on this chart here. If you come to the market and you see the market doing this particular formation, this is what we call the uptrend. That is, the market is in the bullish phase. So the explanation of this is, looking at this, you say this is a high right here, this is a high and this is a low. So now this automatically becomes a range for you. And for this market to continue going up, that's for the buyers to continue dominating this market, the buyers needs to be taking out the highs, which is this and the previous one you saw. So if the market takes out this high, you will see the uptrend is still intact, right? But in a situation where you see the market flip this, which is, you see something like this forming on a price chart, then what the market is trying to tell you is it's in a downtrend, right? When we say the market is in a downtrend, we are just trying to say the sellers are the ones stepping hard here, that the ones dominating at this particular point in structure, where the market gives you a lower high and then a lower low. So this type of formation, the market is just trying to tell you that the sellers are dominating at this particular point in time. Sometimes price is just doing something like this, is stuck. It's not giving you this formation, not this formation. But then you see the market doing something like this, where the market gives you a range, right? It gives you a low and a high. And when you have these 2 levels, which is your swing low and your swing high, so in this case you have something like this now and something like this. So when the market starts to bounce off this from this high to a low, and then it moves like this up to this and then down to this, you see the market is in a range or in a consolidation phase. That is, the buyers and the sellers are equal at this particular point in time. There is no particular winner to showcase who is dominating the market at this particular point in time. So when you understand this, you know when the market is trending and when the market is stuck. If the market is in the uptrend, which is this phase, you want to be looking for buy opportunities only. And if the market is in this phase, which is the downtrend, you want to be looking for only sell opportunities. So now we will talk about break of structure in the market. Now let's say price is in the uptrend, which is this. It breaks a high, which is break above this, making a new high. That break of the previous high right there, which is this, is called a break of structure, or you can say BOS, which is this, right? BOS, that's break of structure. What that means is the trend is still alive. Buyers are still pushing and the market is respecting structure. So for this market to continue going up or to stay in a uptrend, we want to see that the market breaks above this high here, giving you a break of structure again. Same with a downtrend. In a downtrend, the market is not taking out the highs, but then it's taking out the lows in this case. So when the market gives you a lower high and then gives you a lower low, what you want to be doing in the market at this particular point in time is you are looking for sell opportunities. So you had a break of structure right here and the market pushed up, giving you a new swing high, which is a lower high. And then this was the origin that created this. So your involvement in the market is to target this guy here, which is your lower low. The market will have to take this guy out for you to consider this structure a downtrend. So in this case, you saw the market again push to the downside, giving you what we call a break of structure again, which is BOS. So at a particular point in time where the market does something outside or different from what it's doing here, you don't call it a break of structure again, but then you are calling it a change of character. And here is where things start flipping. So let's say you are in an uptrend and you have got a higher high and a higher low. Then suddenly price happens to break the higher low, which is at this particular point, this high is higher than this low. So this is the higher low that we will be dealing with. So you have a higher low right here, and the market does something like this, moves from a high down to this low. That is what we call a change of character, and I'll abbreviate it down here so that you be conversant with the word. So you have a change of character right there, and it's important because it's the first clue that the market might want to reverse. It's not a trend confirmation, but it's just a warning for you to be cautious in the market, because when you have something like this, it's just trying to tell you that you should be conscious in the market. Let's say you are planning to take a buy, let's say around here, and you got stopped out. I think you being stopped out, you won't be looking for buy opportunities anymore, because there's a change of character or a change in state of delivery. And what you want to be doing at this particular point in time is your planning should be more of selling opportunities. But then here is just trying to tell you that, hey, be careful. The sellers are dominating at this particular point in time. And coming to the downtrend or the bearish market, you see the market doing something like this, which is, let me use this to draw this. So you see the market moving like this. So this is a downtrend formation, and for this downtrend to continue or hold, we want to see the market violate the lows and then respect the highs. So at this particular point in time, you saw the market move like this, taking out this high right here. So what the market has done there is it has given you a change of character, which is this. And what the market here also is trying to tell you that you should be careful. The market now is dominated by the buyers at this particular point in time. But this is not just trying to tell you the overall market has turned to bullish or a uptrend, right? It's just trying to tell you, be careful. If you were planning to take your sales, you should actually know that here was the zone you got stopped out. So the market should be paying attention to this zone or this zone now for a continuation. But if it doesn't hold, you still get to know that, okay, we are still in a downtrend. So now here is the summary of the uptrend, the downtrend, and a ranging market. So now here I said a uptrend is when the market is in a bullish phase, and a downtrend is when the market is in a bearish phase. So this phase is where there is more buyers in the market than the sellers, and this phase is where there are more sellers in the market than the buyers. But then this particular phase, which we said is the ranging phase or the consolidation phase, is where neither the buyers nor the sellers are dominating the market. The volume or involvement in the market is relatively equal in the market. So you see the market bouncing from the upper zone to the down zone, but when you have the market break above this zone, you possibly have a continuation to the upside. And if it breaks below this, you possibly have a continuation to the downside. But there are cases where you see the market wick above and then push down to break, but I won't be covering that in this video, maybe in my next video. So now, what we mean by internal and external structure? This one right here separates pro traders and confused ones. There is external structure, which is the major swing that define the trend, and then there is internal structure, that's the mini swings happening inside those big legs or those big swings. So now let's say the market is pushing up, something like this, and you zoom in and see a small pullback that breaks the internal structure, which is, you see something like this. So what you see happening here is the internal structure, because your range is still intact, which is this was your lower range and your range high. So what this is just trying to tell you is the overall directional bias is still in the bullish phase, right? Because the external structure gives you direction, while the internal gives you entry precision. So let's say you saw the markets moving in this direction, which is like this in an uptrend. So after the break of this guy, you have a new swing, which is you have a swing low and a swing high right here. So now that you have gotten swings, which is your swing low and the swing high to work with, coupled with a break of structure, what you want to do is trade the fractal movement to your point of interest to have involvement in the market or get involved in the market. So maybe you wanted to make use of your order block, your fair value gap, or whatever PD array you want to make use of, and the market came to that zone. But regardless, if you pay attention to the fractal movement or the internal structure, you saw a bearish movement that's on a lower time frame. But then this shouldn't fool you to start thinking the market has shifted structure to a downtrend. This is just the correction phase of the market, or a pullback where the market wants to rebalance and then go impulsive. So you have this, which let's say was the last swing, and the market then broke this, giving you a new external swing low, which is this, and then another external. So the market is moving from external to internal, and then from internal to external. That is just how the market moves. And in a downtrend, you want to see the market moving like this. So now that you have a swing to work with, you have a break of structure, which is this, and then you have a swing high and a swing low, which is you have a lower high and then a lower low. So now on the smaller time frame, you'll see a fractal movement of price action playing out, which is you see something like this happening on the smaller time frame. This is just a correction move and not a reversal signal for you. Until the market takes out this guy, then you can start looking for opportunities. But since this high is being protected, you want to be looking for your sell opportunities in the market to target your next draw on liquidity, which is this swing low here. And when this happens, the market still continues this phase to make a correction and then give you the impulsive movement. So now I will be talking about how to use structure to trade. So now here I won't be making use of this drawing board, but then we will go to the price chart so that I will show you my trades I took earlier this week. So now looking at this price chart, we have the market going to the downtrend at this particular point in time, which is we had this low and this high right here. So what the market is trying to tell us is we have a defined range we are working with, because we have a sweep of this low or a break of structure, which is this. And after the break of the structure, the market gave us another swing, which is we had this and this, which is a value swing. For me, I have rules of marking out my valid swings. I must see 3 consecutive candles closing above or below each other. So now that I've gotten a valid swing to work with, I have a low right here and I have a high. So what happened here is the market was coming from a downtrend to a uptrend at this particular point in time, because this high got violated. So we have a shift in market structure. So now after we had this, if we make use of the trend line correctly, so market structure, you see you had something like this. I don't use the trend line actually, but just to guide me on what the market is currently doing. So now looking at this structure here, we have a swing low and a swing high. So now that we have something like this, if I want to see a continuation in the market. We want to see the market take out this high, which the market did. After the market took out this high, we want to see this low be intact. But then if you have knowledge of the order flow, it's actually the primary point of interest, why order block is secondary. So I had this zone here to take my buy opportunity. If you took the buy, it got to your TP, which is here. So after the market got to that zone, which we had just a minor swing, you had a swing low, which is this. So for this market to continue going higher, we want to see this being respected and then this being violated. But then we had a failure swing at this point in time, giving us a break of structure to the downside, which that is a change of character. So now that we have a change of character, we have a zone right here, which is our mitigation block. And looking at this range, this was the overall range that led to this swing being created. So we have a full confirmation that this is a valid shift in structure. And my first pullback after a break of structure is usually marked as inducement for me. So I have this as my inducement because this never came to mitigate my order flow, which is my primary point of interest. And I had my last down close candle. So for me to mark the last down close candle here, I usually make use of my line chart. So this is where I got the last down close candle. So marking this is where I will take my entry from. So we have a swing low to target as our take profit. And this then is my entry, my stop loss above the swing high, and then my TP below the swing low, and it played out. And then this was again my second entry, which after the sweep or the break of this structure here, we had a order flow, which is this. So having this order flow, if you want to take this type of entry, you want to make sure the market trades into the 50% of this candle. So from using this tool, we should be able to see we also have this zone as our area of liquidity, which is inducement. So I have my inducement right here, and the market broke inside and it's trading in the premium zone. I don't want to have involvement in the market when the market is trading in the discount zone. When I want to sell, I want to see the market in the premium zone. And again, for me to take my entry, I want to mark my down close candle, and my down close candle must be in the premium zone. So I have this right here, which is my down close candle, and that will be my entry. So my entry will be here, and then I'll be targeting the next joint liquidity, which is the swing low. If the stop loss is large for you, you can minimize your losses by placing it above here, or you can still place it above the swing high, which is your lower high, and targets the next draw on liquidity. So that is it. And if you stay focused on mapping out the market structure correctly, then you won't be battling with having good entries. You won't be battling with taking your trades against the trend. So now I will be talking about common mistakes most traders make when they are trading using the market structure. And the very first common mistake is reacting to every break of structure like it's a reversal, where we mentioned earlier how the market moves in fractal when it gives you a range, and the fractal movement, which is a correction, shouldn't be traded as a full trend but just a correction, and that should be a counter trading. And most of the cases, that's just liquidity being grabbed. So trading against higher time frame structure, if let's say the 1 hour time frame says we are in an uptrend, I don't think you should be fighting a higher time frame on the 5-minute chart or the 1-minute chart. And the third thing I'll tell you is zooming in too much and confusing noise for trend. So in a situation where you come to the chart and you start to zoom in your chart like this, it's not too necessary. What you want to be doing in the market is to focus on the current trend, and zooming in excessively is more of for those who are doing swing trading. If maybe a market skipped a zone like this, for example, let's check where the market reacted from. So good. So now if you pay attention to the zone, we had a break of structure right here, right? So this break, I think it had a zone here, which is this. So let's see what happened. Good. If you zoom in closely, you should see this movement also. This particular movement never mitigates that zone we marked, and then when the market visited it, you can see a drop. You understand? But still, market reacted from that previous zone, but still you have got a order flow right here, which is we had a sweep of this, and then the market came to it, which is your breaker block. So now the market is still reacting at this breaker block here, pushing price higher. So that is it for this video. In my next video, I will be talking about liquidity, inducement, and smart money levels. So if this video was of help to you, kindly subscribe and like the video to give your support to the channel. Thank you, and see you in the next one.